Hi, welcome to the First Trust ROI podcast. I'm Ryan Isakainen, ETF strategist at First Trust. For today's episode, I'm joined by Chris Bush, Vice President of Strategy Research and Portfolio Manager for the First Trust Active Factor suite of ETFs, as well as a small cap core SMA. Chris and I are going to talk about what's happening in artificial intelligence, banks, why the S&P 500 has been so difficult to beat this year and in recent years, and how factors can help design portfolios to hopefully outperform over time. I hope you enjoy this episode of the First Trust ROI podcast. Well, Chris Bush, great to have you on the First Trust ROI podcast. We are recording this in the beginning of April, and we're recording it before the weekend of when we're going to find out who the college basketball champion is. So I'm tempted to ask you who that's going to be because it's going to post right afterwards. So I won't do that to you because I'm not sure if you have a favorite. Do you have a favorite in the March Madness tournament?
Yeah, I would love to see Purdue win it. 40 years since they've been to a Final Four. Zach Edey, 40 points in his last game. So it would be really cool. You know, there's a lot of Boilermakers around here, so I'd love to see a Big Ten team win it for the first time in a long time.
Yeah, that Edey guy is a monster. Yes. He is a force of nature. And again, it's always fun talking about it before it happens, but it's going to post after it happens. The other thing that's going to post, when we post this episode, the other event that's going to be happening is a big solar eclipse. Did you know about the solar eclipse that's happening on Monday?
I did not, but it sounds like you're a pretty big nerd if you know about this solar eclipse, maybe a little bit.
I know about it because it's the path of totality is going over my house.
That's pretty cool.
And my kids actually get the day off from school.
Wow.
It's really, I don't remember when I was a kid ever getting the day off from school for a solar eclipse, but that is what's happening for my kids this year.
Kids are going to love that.
The kids, yeah, and they've all got their solar eclipse glasses so they don't burn out their retinas. It's all very exciting. Well, again, thank you for coming on the podcast. Sorry for the quick divergence there. Okay, so one of the things I wanted to talk to you about, because you are a portfolio manager that's running a couple different actively managed equity ETFs, the Active Factor suite of ETFs. There's 3 of those. And this is a trend that we're seeing gain steam over the past year or two, really, is where it's picked up so much, where we're seeing more and more flows and assets come into actively managed equity ETFs. At first, it was, kind of fixed income is where most of those assets flowed to. What do you think's behind that? Why are investors becoming more comfortable with it, or is it just because fund companies are moving in that direction? What's your take on that, Chris?
Yeah, so I think there's a couple things. So number one, ETF is just such a good wrapper for any type of product, whether it be passive or active. So you're just seeing the proliferation of ETFs, number one. And number two, look, there's a lot of really good strategies out there. So, I do run a fundamental fund, but as well factor-based funds. And factors work if you do them well. So building a quant-based strategy into an active ETF wrapper makes a ton of sense.
So I think one of the challenges for active managers, especially over the last 5 or 6 or 7 years, has been that the S&P 500, that everyone seems to benchmark to the S&P 500 in some way, whether formally or informally, that's what they're compared to. And it's been really, really difficult to beat the S&P 500. So I guess, why is that? Why has the S&P 500 been so difficult to beat, especially over the last several years?
Yeah, so you look back to last year, 27% of stocks beat the benchmark last year in the S&P 500. So narrowest market we've seen since at least 1995. And you just look at, we have extreme market concentration today. So it's a couple things. Number one, big tech has been phenomenal, right? It makes up a huge part of the market. And you've seen a nice recovery in their earnings. And and there's been a lot of themes out there. AI being the major one that is really push to investors to a lot of these stocks. And at the end of the day, these are some of the best of the companies in the world, and they have dominated the equity market performance, which means the other 493 outside of the Mag 7 have really been left in the dust a little bit.
I want to kind of drill down into AI in a minute, but before we do, there was something else that you mentioned before about factors. Yeah. Factors being an important part that really forms the foundation of some of our more passive strategies, which are, not passive in the sense of set it and forget it, but passive in the sense that it's rules-based, it's an index. And we also employ that in some of our active strategies. So I want to talk about factors. Can you define what we mean, first off, for those that are not as familiar with what we're even talking about? What is a factor?
It's a similar characteristic across a group of stocks. I look at factors, there's really two key inputs that I would put in to make it a true factor that actually adds value. Number one, there has to be empirical evidence that it works. So if I'm looking at a value factor, let's say we believe in the value factor, there has to be evidence that it works across different asset classes. So it can't just work in one time period across large cap stocks, right? It needs to work across large caps, mid caps, small caps. It has to work across international styles over time. Now, all factors go through periods of underperformance. Not a surprise the last decade to anybody listening, that's been a rough period for value. But number one, there has to be strong empirical evidence behind it, what we define a factor. And number two, there has to be sound economic rationale for why a factor works. So the value factor, cheap names, a group of cheap names tends to outperform expensive names over time. And that behavioral thought behind it, that makes a lot of sense to us, right? When you go to a store, what do you want to buy? Do you want to buy something that's full priced, or do you want to buy something that's on sale? So when we think about a factor, we always think about things in groups like sector groups or growth versus value. But when we think about a factor, it's a similar characteristics, or whether it be value or quality or momentum, that does meet those two key criteria of economic rationale and empirical evidence that backs it. So in our minds, there's a very small set group of factors that fit both those criteria.
Okay, so you mentioned value a minute ago, and value in its simplest form is, yes, something is cheaper than something else, whether that's based on forecasted earnings or book value or cash flow or a number of different ways to measure value. But on the other hand, things are cheaper generally for a reason. And so, how do you square that? The fact that, yes, this stock A is cheaper than stock B, but it's also going to have, maybe its terminal value is much lower. Maybe its cash flows over the next several years are lower. So how does that figure into your thinking on why value should work?
Yeah, so if you look at history, people tend to over-extrapolate growth names. So you expect growth to be here, here, and here. And as you know, with the equity market, it prices in based on expectations. So if you don't hit those expectations, say you're a really high growth name, let's say you only grow 20% and you're supposed to grow 25%, likely your stock is going to get hit. So it's a lot of over-extrapolation on the growth side, and then maybe a little bit priced, as Graham and Dodd would say, there's a margin of safety in a lot of these value names. Maybe they were only supposed to grow 5%, but maybe a name grew 10% and the stock recovered because it was trading at such a lower valuation. But yes, there's reasons why, value doesn't always work. And, and maybe we'll talk about this, but at First Trust, we're big believers in multiple factors, combining them together.
Yeah, let's talk about multiple factors as well. But what I'm hearing you say is something's cheap and we think it's cheap for a reason, and it's always going to be that negative, whatever's causing it to be cheap is always going to be the case. Or something's growing faster and we think we extrapolate out in the future, it's always going to grow above average, but none of us knows the future. And invariably, the whole set of stocks, none of them are going to be as negative as we think they will. If we've got just sort of an emotional, distaste for a stock, and on the growth side, none of them are actually going to be as good as our optimistic view says. Is that kind of what do I have that right?
And that's on average, right? So hopefully you're right a little bit more than you're wrong in those baskets. So maybe 6 out of 10 of that value basket outperform. There's going to be value traps and there's going to be names that don't work, but on average, over a long period of time, you expect to win based on the sound empirical evidence behind like the value factor.
Yeah, and that's why you want to capture that within a group of stocks instead of just maybe picking one stock because it's cheap and then you find out that it's a value trap and it was cheap for a reason and it stays cheap or It gets cheaper. Okay, let's talk about multiple factors because I think that's an important part of the discussion as well as we're thinking about building portfolios using factors. Talk us through that. What are some factors that maybe you would combine together?
Yeah, so I think a great example, we've kind of talked about this, there's value stocks that are cheap for a reason. So a great factor to combine it with is the quality factor, right? Because on average, the average value stock tends to have worse balance sheets, tends to be less profitable, tends to be more cyclical. So why not buy value stocks that tend to have more quality to them? So good balance sheets, stable profits, high margin type businesses. So we love combining those together because I think you get better businesses. You avoid some of those value traps. And on top of that, look, not every factor works every year. So right now, this market, it's been a very, very good quality market. That's been a really strong performer, and value hasn't been nearly as strong. So it can definitely smooth out that return profile over time.
When you look at the different factor baskets, just on looking at quality versus value versus momentum versus low volatility and all the other factors that you consider, is there a way to capture when you look at the valuations of those factors to determine whether they're expensive or cheap, and how do you do that, especially with a factor like value, because value by definition is cheap? So first off, how do you measure it? And then secondly, is there anything that stands out as being attractive right now?
Yeah, so how do you measure the value of value, right? Yeah. Or the momentum of momentum, or how cheap momentum is, or how cheap quality is? There's a lot of different ways to do it. One way we like to do it is we like to look at their forward PE ratios. So we'll look at values, forward PE ratio relative to the market based on history. So is it cheaper than it normally is cheaper? So we'll do that for each of the 6 big key factors that we'll look at. So we can go into what's cheap and what's not, or we can take it, but there's a lot of different ways to do it. But at the end of the day, we're going to look at it versus history, because you are absolutely right. Value should always trade at a discount to growth. Because,
by definition, right?
Yeah, by definition, right? They're not quite as quality, and they shouldn't have as high a growth prospects. So they should trade at cheaper valuation. It's just how big.
When you look at those 6 factors, one that stands out to me as having underperformed over the last couple of years is the low volatility factor. And that seems to be something that should work well when there's stress in the market, maybe when there's a risk-off scenario. And so it kind of makes sense as the rally that took place in 2023 in particular, that low volatility would underperform. What's your opinion on low volatility? Is that something that you would expect to maybe outperform in I guess this year, next year? What sort of environment would you expect that to outperform in?
It's a great factor for a risk-off environment. As you stated, the S&P was up 26% last year. NASDAQ was up a lot more. Everybody wanted anything tied to tech and AI. So clearly, a low vol factor was not where you wanted to be last year. But what's interesting now in this market is the VIX is pretty low. There's not a lot of interest in risk or hedging your portfolio, but boring actually looks cheap for the first time in a long time. And given that we could get potential rate cuts, low vol tends to do pretty well because those stocks do tend to be decent dividend payers that act as bond proxies.
So this maybe is a theoretical question there's not a good answer to, but do those low vol stocks perform well because of the rate cuts, or because you're in usually when rate cuts happen, it's in a risk-off sort of challenging economic environment?
Sure, yeah, there's definite economic regimes, and for sure that will play into it. But over time, the reason low vol tends to work is people don't want those boring names. They want to go after those high flyers that are more story stocks that tend to do better, or investors think will do better. But at the end of the day, it's a good factor. But there's weaknesses of low vol too. Low vol didn't do well in 2020. Why didn't it do well? Because low vol stocks tend to have bad balance sheets. So it actually has a bet against quality, and think when the world was shutting down. So we don't think any of the 6 factors are perfect. We think that they all have some drawbacks. And really, at the end of the day, how you build a factor model is very important and can drive different outcomes to your portfolio.
Okay, so we're going from low vol. Before we were talking about the Magnificent Seven and the technology sector and artificial intelligence in particular. And I want to kind of land there for a few minutes because this is, for most investors, kind of came out of nowhere. ChatGPT, it was first released to the public in, I think, November of 2022. And it took a couple months for people to really know, what is this thing? And then before you knew it, there was just a huge rally that took place on the back of some of the optimism surrounding AI. So I want your opinion on what's actually happening there. Is this something that you think is as game-changing as the market seems to expect it to be? Are we, overly hyped? Are we not appreciating the magnitude of what's going to happen? Do you have a view on AI?
Yeah, so I think there's real use cases here, right? In these LLM models, where
LLM being large language models.
Yes. Sorry,
I'm just trying to cut through the jargon for the podcast viewers and listeners.
Like when you first got on ChatGPT, it was really cool. Like, hey, plan my trip to Italy for my family, and it would spit out some answers, and it would be mostly right. And but for corporations, there's a lot of huge opportunities. So is there opportunities to cut expenses because there's some jobs you don't need anymore? Absolutely. Is there opportunities to make these jobs more efficient? For sure. Can it help write code, right, for your programmers? So maybe you need a programmer or 2 or less, or make them more, making them better at their job. So there's surely some opportunities there. And there's obviously extra revenue opportunity. You look at a company like Microsoft, their Azure cloud offering, they are seeing an uptick in revenue thanks to some of their AI initiatives. But so what's interesting is it has been, the biggest winner has been the AI enabler, NVIDIA, right? And why have they been such a winner? Because they supply the compute to the market. They've done extraordinarily well. But what will be interesting is, what is the next leg of this? Because if companies can't figure out how to monetize it or cut costs, at some point, that's not good for a company's stock price. So, how I look at it is, if you look at the market today, I can really point out Microsoft and NVIDIA have benefited from AI. But you look at a lot of other names, you really haven't seen it show up in the fundamentals. So you look at revisions. So what revisions is, if you compare profits a company's expected to earn this year today versus 3 months ago, and if you look at semiconductors ex NVIDIA, revisions have actually been negative. Yet a lot of semiconductor stocks have continued to go up. So like a great poster child example would be like AMD, who also is trying to break into the GPU market. And what's interesting with them is their estimates for this year continue to move lower. So what Wall Street expects for them to make in profits. But next year they moved higher. So what we call them in the industry is long duration equities. Mm-hmm. Think about like long duration fixed income, but for equities. So now you're basically making these tech names longer duration equities, because it's been a lot of hope. So there's a lot of hope in this market today for a lot of these AI names. So I have a little bit of a twinge of caution, mm-hmm. Given that there's only been fundamentals show up for a few of these names.
Right. Yeah, and it seems like maybe there's a little bit of FOMO that's happening in the market with some of these names. Fear of missing out, and so you end up driving some prices higher that maybe don't yet have the fundamentals to support that. Chris, you're a small cap manager. You've got a great small cap managed account that your team manages, and so outside, it seems like most of the AI enthusiasm and excitement has been with some of those big names that you mentioned before. Do you expect, or have you seen any smaller names start to catch an excitement, enthusiasm bid related to AI?
The biggest weight on the Russell 2000, the small cap benchmark today, is a company called Supermicrocomputer.
Mm-hmm.
And so what Supermicrocomputer does is they make custom servers. And really what caught on with them is they have some good cooling technology. And they can make them pretty fast so they can get them out there. But they're kind of the Switzerland of AI because they can put NVIDIA's GPUs in there. But they've really caught fire and their fundamentals have improved. But this is a name that really, you look at this time period, it epitomizes it. So I will tell you, Supermicrocomputer, I met with their management team about a decade ago at a microcap conference. Okay, today they are a $58 billion market cap. So they're significantly a large cap today. So they have really caught this wave of AI euphoria around it. But I will tell you, their gross margins before this really take off the last couple of years was close to 15%. Today, it's still around 15%. So yes, have their fundamentals improved? Absolutely. But it's just one company where you've just seen a massive euphoria around it. And I'd say, hey, you got to be a little careful. It's also a very shorted stock. So when you get a massive short squeeze, it does kind of remind me a little bit of the meme stock days, what we'll see. I'll give you one other example. Another company benefiting from custom servers is Dell. So really the last time I cared about Dell was, dude, you were getting a Dell in the early 2000s. Yeah. I was a teenager. I was like, I'm getting a Dell. Now it's, dude, I'm getting an AI server, and their stock just popped a couple of weeks ago. So it's pretty amazing, some of these old dog stocks that have come around. So I would say, hey, look, there's definitely opportunities here. I think big tech is a lot where you're going to see most of the winners. So be a little bit careful with some of these smaller names because there gets to be a lot of euphoria around it. And especially if the fundamentals aren't keeping up with the names, I'd be a little bit concerned with some of the moves we've seen in some of these smaller cap names.
So stock picking isn't maybe as easy to kind of ride the momentum because momentum, and we didn't talk much about momentum when we were talking about factors, but that can come and go pretty quickly, can't it?
Yeah, so I will tell you, February of this year was one of the best months we've seen for the momentum factor. So this is an extremely narrow market driven by a few names. And you're seeing it across a lot of different sectors. GLP-1 stocks, the weight loss stocks in healthcare are doing really well. Everything else is doing poorly. And really, to me, this market today comes down to NVIDIA. How is NVIDIA doing? And I will tell you, though, what happens with a momentum market or a momentum factors, there's an old Wall Street adage, you tend to take the escalator up, you tick up, outperform, and then you take the elevator down.
Okay. And that's a good segue to another topic I wanted to get your take on, and that is the regional banks in particular, because there's been a few where it's seemingly out of nowhere last year, they just ran into trouble. And some of that was specific to the regions that they were in, like Silicon Valley Bank and some very specific things. But I guess my question is, what's your take on the regional banks as a whole? Is that something that has gotten attractive today? Is that something that people should be risk averse surrounding those names? Should it be a stock pickers sort of thing? What's your take on risks?
Look, I do think you need to be selective. I think there's some really good regional banks out there, but I think we need to back up and look, what are the risks to banks? There's really three key risks, right? There's interest rate risk, there's liquidity risk, and there's credit risk. So what did we experience last year with Silicon Valley Bank? What markets saw was they took too much interest rate risk, right? They were investing in treasuries and mortgage-backed securities. It just happened that rates went a lot higher than anybody thought, and they had big unrealized losses on their balance sheet. And then the liquidity risk kicked in because their very concentrated deposit base started pulling money out. So that caused a run on the bank. Because at the end of the day, every bank has an asset liability mismatch. And the lesson you learned from that was you need a diversified deposit base. So that was the issue we saw last year. This year, NYCB Bank, completely different situation. what their issue is in New York, there was a law change in 2019. And the law was before, what would happen is these owners would go in, buy a rental property, and it was rent controlled. So let's say you could only charge $600 a month for this property. But what they would do is they would raise that rent from $600 to $2,000 or more over time, and they remove it from that rent controlled property. What happened was in that 2019 law change, no longer could you raise the rent. So a lot of these owners of these properties started defaulting on these properties. And guess what? NYCB, their loan portfolio, had a lot of exposure to these rent controlled properties. So they are a little bit of a one-off. And what I will tell you is what we saw last year is completely different than what's going on with NYCB. And the question to me is, when do we have a credit cycle in the U.S.? And so are regional banks a good investment? They're cheap, but guess what? They have a ton of commercial real estate exposure. So I think we will see who are really good underwriters when we have a credit cycle. So I think it is, just to answer it shortly, it is a stock picker's market. Be selective. There's good opportunities, but there's also definitely some landmines out there.
Yeah. So are there any specific characteristics or things that people should either gravitate towards, or maybe as they're kind of doing their due diligence on some of these banks, what should they look for?
Yeah, I think you want a bank that has a really seasoned management team, that has a long track record of success. And one of the other big advantages of a bank, and part of the reason why the big guys is winning, is they have a diversified, lower cost deposit base. And that's really where you can get a little bit of a moat within the banking sector.
Commercial real estate is another issue that I think many people have been concerned about, especially when it comes to banks, and the fact that their occupancy rates are low, and there's concerns about whether or not they're going to be able to service their debt to those banks. So in your opinion, is this something that we should be concerned about? Is this something, even though it's well known in the marketplace, is going to surprise people, especially when it comes to banks?
Any earnings call I listen to or read now, analysts are very focused on where are your loan exposures, what regions are in. Commercial real estate is this giant blanket that everybody, or umbrella, I should say, that everybody puts a lot under. But there's a lot of there's data centers, right, in commercial real estate. There's A-grade malls. There's A-grade commercial real estate buildings. It's really those lower tier where the issue is. And I think it's just a case by case. And part of the reason we haven't seen it play out is it's slow burning, right? A lot of these commercial real estate deals are 10, 15, even longer year terms. So, but the economics on a lot of them, especially in some, cities like a San Francisco, where you've seen a lot of people leave, there are risks there. So I think at the end of the day, this will become a much bigger issue when we get a recession, when we get a credit cycle.
Mm-hmm.
And then I think we will see, going back to, if you were a bank with really good lending standards, you're going to be absolutely fine because you diversified your risk. But we're going to maybe find some more NYCBs or Silicon Valley banks that didn't have maybe the right risk controls in place.
Now, one of the things that has over the years historically been good for banks oftentimes is when rates move higher. And a lot of that has been, when the yield curve steepens and maybe you've got a better spread between longer rates and shorter rates. In this cycle, we've got an inverted yield curve, and rates went up super, super quick as the Fed was fighting inflation. So I think there's probably some people watching the podcast that don't really fully understand, myself included, what sort of environment from an interest rate perspective are they going to thrive in? What's good for banks? Because it seems like these higher rates now maybe have slowed down some of the, especially mortgage underwriting and that sort of thing. And so will they do better if the Fed lowers rates in this environment? Do they need a steepening of the yield curve? What's your take there?
All right, so two key things here. Number one, an inverted yield curve is not good, right? Because at the end of the day, you have to pay your deposit base. So if I can go get 5+%, in a money market or wherever I'm looking, like banks need to be competitive on the short end. So uninverting the yield curve would be great, and you would likely see that if we got some rate cuts. So that's number one. And number two, a lot of these banks still have massive unrealized losses on their balance sheets. So if rates did go down, those losses will be cut. So it's a little bit, yes, you always hear higher rates, good for banks. But this is one of these kind of upside, downside, backwards things right now where rate cuts actually could be a big benefit for banks.
Yeah. Now, the tricky part about that is, do rate cuts come at a point in the economic cycle, or you're
Yes.
getting rate cuts because the economy is weakening, therefore you have less appetite for lending, and maybe your credit standards go up, and so it is a tricky, complicated issue.
Yes, because we have not seen a credit cycle. I mean, charge-offs for banks are near record lows. So, in some ways, banks are over-earning today. If you manage your balance sheet well for interest rate risk and you have really low credit losses, a lot of banks are over-earning today. So, yes, it is a mixed bag. I will tell you that with banks in general. Yes, they are cheap, but there are still risks there.
Okay, Chris, I'm gonna finish our discussion today the way that I have finished a lot of the podcast episodes, and that is to ask you, on the Chris Bush reading list, what stands out? What have you been reading lately that's interesting that the viewers and listeners of the podcast might appreciate?
Yeah, so I'm into a book right now. It's called Masters of the Air. So just think of Band of Brothers, but for the U.S. 8th Division Air Force in World War II. So it's all about the bombers moving the U.S. Precision bombing, going from England to over Germany. It's just a fantastic book for a couple of reasons. Number one, it was like the most dangerous job to have anywhere in the military to the war. So these guys sacrificed a lot. And then number two, the other cool thing about it was that these guys were all volunteers, and they came from all different walks of life. So you could have a lawyer from New York right next to a guy working in a coal mine in West Virginia. So it's something we don't often see today, the coming together, the unification that we sorely lack today in the U.S., and just seeing the sacrifice these young men did to protect our freedom. So I highly recommend it. It's also a show on Apple TV that is out as well.
Okay. Yeah. Well, Chris, I really appreciate you sitting down with us. Thank you for your insights, and we'll have to have you back on the podcast at some point in the future.
Appreciate it, Ryan.
All right, thanks. And thanks to all of you for joining us on the First Trust ROI podcast. We'll see you next time.